Today, I'm going to share with you one of our biggest failures and how we lost £20,000 in one deal. I'm going to be talking through the main failures and the lessons behind those failures that we've learned since. What I would say about this, although it was a massive failure, we've learned a lot. It has really helped us since. I'm also going to be sharing with you a model to reduce your chances of this happening to you. So the property itself was a flip, and it was in Sunderland, which is an area that we know and really like to invest in. We bought this property at auction. It was quite a large property, and someone had passed away and the family were selling it. It was very kind of neglected and old inside, so needed a lot of work, including a new slate roof. We bought the property no money down, so none of our money. We used other people's money. We used an investor loan for 25%, which was the deposit, and we used 75% using bridging and development finance on the refurb as well. And all of that meant that our finance costs into the deal were really high. So let's look at the deal numbers. Property was purchased for 195k. And as I said, that was through auction. The refurb ended up costing 66,000. It was a full refurb, but the costs did go way above our budget. The buying and selling costs actually were pretty high. That is because we bought it in auction and sold in auction. So we had two fees either end. And then obviously there was stamp duty and two sets of legal fees. So all of that added up to quite a lot. The finance fees, which was the thing that really killed this deal, were £36,000. And that was all because of the delays, and that's where really the biggest impact on this deal was and why it ended up being such a loss. So all of that is a total of 314k. And we ended up selling it for less than we wanted. We sold it for 294k, and that unfortunately meant a loss of 20k, with the biggest overruns being these finance fees and the refurb. So the first failure was around the sale timelines and method. So this was a flip property, and flips are all about quick timelines, smooth projects, getting in and out of that deal as quickly as possible. Now, what actually undermined us on this deal was that didn't happen whatsoever. We had months and months of delays. We had about 6 months of delays between when we anticipated selling the property and when it was actually finished by our builders. What that meant was that we incurred, firstly, large finance fees because it was on bridging and investors loan. So our finance fees went like way above what we wanted, and we had issues with actually putting the property on the market and the market kind of changing a little bit in that period, and it was a more difficult time to sell. One of the solutions that we came up with at the time to help mitigate the delays in the build, we created some CGIs of what the property would look like to get it on the market as quickly as possible. Then what happened was viewings happened, but the property wasn't finished. So the CGIs looked really slick and it attracted a lot of interest. But then when the people went round, they were like, well, this is great, but it's not finished, so we want to see it when it's finished. And then by the time it was finished, this was quite a long lag in between the viewings and when the property was finished, of like 3 or 4 months. It meant that those people had already moved on, they had already purchase something else. And then talking about the method of sale. So what we actually decided to do to help mitigate our losses, we sold it at auction. But with auction, there are terms that need to be met around completion deadlines, which is normally 4 to 6 weeks. And that means you normally have to buy in cash. So that kind of puts off a lot of buyers. So that then restricted the buyers that were available, which then decreased demand, which ultimately then decreased the end value and the price that we're able to sell it for. It was meant to be a solution that was there to help us, but ultimately, I think in hindsight, it might have been better to sell it in the open market and, risk having someone pull out, but we probably would have attracted a wider amount of buyers, which would have probably driven the price up to, again, minimize the loss. So the second failure was around our build team and the dependency we had on them. So this was actually a team that we had used previously, so we weren't just going with someone completely unknown. So there was a level of trust there, but I think in some ways that was our downfall. We kind of just ignored them and had belief in them that they would actually finish the job. What ended up happening is that they dragged it out. They dragged the last sort of probably 10 to 20% of the job, all the small things, they dragged it out. So the laying the carpets, doing the final bits of painting, doing the externals like the yard needed doing, fitting the internal doors, all those kind of bits that normally happen towards the end, they never actually got finished. So that caused us a lot of problems, particularly with the viewings. And what we actually found out afterwards, that these delays were actually caused by a lack of cash flow on their side. So the reason they were dragging it out is because they couldn't actually afford to buy the materials or send guys in to do the work. So they had to get money from other jobs in order to then finish this job. So that's why they kept delaying it. But we didn't know that at the time, but that makes, complete sense. It became very difficult to get rid of them and sack them. That would have been the best course of action ultimately in hindsight. But at the time, that just felt like that would cause more delays because we have to go out and find another contractor, and it's also quite difficult to find a contractor to essentially pick up someone else's work, and we knew that there would be cost implications to that as well, and it's unlikely that they would have done it for the same price. So it's very easy to sort of say now, but really the initial delays that we saw should have been red flags and we should have dealt with them at the time, but because of maybe a little bit of naivety or lack or blind sort of trust in them, we didn't end up doing anything about it, which obviously we now regret. So lesson number one here, and what we've now done differently as a result of these failures, is we carry out much thorough due diligence on anyone that we work with, whether that's a builder, a supplier, a solicitor, because we don't want to just rely off trust and instinct and personality, for example. We need to understand, are they going to deliver on what they say they're going to do? Are they actually trustworthy? What is their kind of background and history? So for example, we have a due diligence process that we follow through for our contractors. So we have kind of a set of interviews with them where we've got a set of questions to ask them to understand their background, their capacity, how they work. We will do credit checks on them. We will do due diligence on them and their company. We will also ask for a kind of portfolio of their work. We will speak to at least 3 of their clients. We'll go and visit one of their jobs. So all of this just ensures that we have a much better understanding of that contractor before partnering with them. The second lesson here is around risk management and contingency planning. Well, what would happen if we didn't get the price that we wanted? What would happen if this project did run into delays? Because of the finance cost, we were using other people's money and therefore had quite high interest payments. Those delays did risk this deal. Because the margins were actually fairly slim at the beginning on the deal itself, there was quite a high risk that any delays were actually going to then eat into that margin. One thing we do now is we carry out like a risk assessment exercise on any big deal that we're looking at. So we will dive into each of the different risks and all the different permutations and essentially come up with a plan of action for each of those and discuss the level of risk for each of those. What would happen if the worst case scenario does occur? And that allows us to make a better decision on whether to move forward with the deal depending on our risk tolerance and depending on the deal. And this would be my advice to you, that you carry out a similar risk management exercise as part of your deal analysis. Think about how much the risks can be mitigated and also think about your risk tolerance. Another example of this risk management exercise that we should have done was around the finances. The only exits available on this deal were to sell it, really, because it didn't make sense to refinance it and hold it. So having multiple exits is great contingency planning, and that's where this deal actually fell down. So in hindsight, we probably shouldn't have gone ahead with the deal the way that we structured it. If you want to hear stories and lessons from failures and how successful entrepreneurs have bounced back from major challenges and setbacks, do check out Beyond the Fail podcast. That's my new podcast, out now on all platforms, wherever you can get your podcasts. So I'm going to share with you a model which would help you to make better decisions and to carry out more effective risk management and that worst case scenario contingency planning that I've mentioned. So this is a risk management model, and it's a really useful tool for making any decision. So the first step in risk management is to identify. And this is where you need to start by thinking about what could go wrong, what could cause a problem, what things you need to be prepared for, what's the worst case. Next step is to assess the risks. And in this step, you think about how likely it is that the risk will actually happen. And you give that a rating. So low, medium, and high. So in this example that I was giving, essentially the likelihood of, for example, overruns on the refurb were probably quite high. And then you need to think about the impact. If this happened, what would be the impacts? How bad would it be? What would the consequences be? And again, you need to do that on a low, medium, and a high basis. So in my example, the consequences and impacts of a budget overrun on the refurb had a likelihood of pretty high and an impact, I would say, of medium, because they would have impacted on the overall margins of the deal, but probably wouldn't on its own have completely killed the deal. However, if I had looked at the likelihood of delays in the refurb and delays selling it, for example, the likelihood of that was probably medium, but the impact of that would have been high because of the consequences in terms of delays in selling it, which means that we've got more bills to pay, and most importantly, we had higher finance costs, which would have killed the deal. So by carrying out that assessment, you're essentially looking at both of those elements, and then you're coming up with essentially a risk rating because of that. And you could even put numbers to this. So it might be that this is 1, 2, and 3, and this is 1, 2, and 3. My example of delays was medium likelihood, which is 2, and then a high impact, which was 3. So that's a risk rating of 6, which in my world here, looking at these numbers, I would say is a high risk. So the next stage is to manage the risk. So now you need to decide what you can do to reduce the risk. Is there anything you can do to mitigate the risk or lessen its impact? See, the mitigation is all to do with the likelihood, and the second point is how do you lessen its impacts, and that's all to do with the consequences and the impacts. And both of those will therefore reduce the overall risk rating and the overall consequences of that thing going wrong. And this is all about, this is your plan of action. And the key to risk management really is to ensure that you are prepared, you're aware of all of the risks, and you have a plan in place to when things don't go as expected. This model can be used in any sort of situation, planning an event, making decisions, or dealing with everyday challenges. And it's a fairly simple and straightforward risk management tool. And lesson 3 is single point of dependency. So what is single point of dependency? It can be simply defined as having one thing or one person that's really important for something to work. It could also be seen as that one piece of the puzzle, if it goes missing, you can't complete your puzzle. So if you think about a bike, that's a really good example as well. So a bike has a single point of dependency on the pedals, because without the pedals, the bike's not going to go anywhere. So we had a single point of dependency on one build team across our business. So the main builders that we were working with on this job were kind of the only build team, reliable build team that we knew of. And what that meant was, as I discussed earlier, is it was really difficult to swap them out and sack them when the problems started to appear. So now what we've changed is that we work with a number of different build teams. So we don't have a single point of dependency on one, and we're able to spread our risks across many different contractors. So working with a number of build teams just gives us a greater level of flexibility and enables us to kind of problem solve a lot more easily. And that's something we didn't have on this failure that we're talking about. And it would have been great to be able to swap out the contractor, because as I said, the timelines were really tight and we really couldn't afford any delays, and the margins and the finances were really tight. Those delays just really led to the losses that we saw in this job. We could have swapped in a new build team to then provide a really smooth transition, which would have then helped mitigate our delays and losses. So what you should take away from today is that failures don't necessarily mean the end, and that actually failures can be really beneficial and can be really great learning points to then help improve yourself or your business going forward, and actually put it in a much better position because you've gone through such a hardship and such a stressful and difficult situation, because that's exactly what we found. And actually we're in a much better place having had that ordeal and that loss. Our business is much stronger for it, and that should give you the reassurance that failure isn't finite. It's actually a key part of the process. Thanks for watching today. Really hope you've enjoyed this one. Please do subscribe to our channel and like the video. All your support does make a huge difference, so thanks in advance.